This is the business black book, where billion-dollar empires are built and collapse. America owes $36 trillion, not to one country, not because of one president, not because of one war. It is the result of decades of decisions, compounding quietly until the number became too large to ignore. This is the business black book, where billion-dollar empires are built and collapse. So today, we are going to decode the American debt crisis, not the headlines, not the panic, the actual system behind it, how it was built, why it keeps growing, and why the world, including India, is watching very carefully right now. Let us start from the beginning. What exactly is national debt? Because most people confuse it with household debt, and that confusion is where the misunderstanding begins. When a government spends more money than it collects in taxes in a given year, that gap is called a deficit. To cover that deficit, the government borrows money. It does this by issuing bonds, which are essentially promises. The government says, "Lend me money today, and I will pay you back with interest later." Every year that the government runs a deficit, it adds to the total pile of borrowings. That total pile, accumulated over decades, is what we call the national debt. For America today, that number stands at $36 trillion. Now, 36 trillion is a number that is almost impossible to visualize. So let us put it in perspective. The combined GDP of China, Japan, India, the United Kingdom, and Germany is less than $36 trillion. America's debt is larger than the economic output of 5 of the most powerful nations on Earth combined. And what makes this more alarming is not just the size, it is the speed at which it is growing. America's debt has now crossed 122% of its own GDP. That means the country owes more than it produces in an entire year. And projections suggest that if current policies continue, this ratio could climb to 140% by 2032. This is the central problem we are going to understand today. Now, to truly understand how America got here, you need to understand 3 forces that have been working together for decades. Think of them as 3 rivers, each one flowing separately, but all 3 eventually merging into one massive flood. The first river is the spending problem. In a well-managed economy, governments typically spend more during hard times and pull back during good times. That is the basic logic of counter-cyclical spending. You support the economy when it is struggling, and you save when it is thriving. But America has not operated this way for a very long time. The United States runs a budget deficit almost every single year, regardless of whether the economy is doing well or poorly. In good years, it spends more. In bad years, it spends even more. And the categories of spending that drive this are largely fixed. They cannot be easily cut. Consider this: America's defense spending, Social Security, Medicare, interest payments, and mandatory programs together account for roughly 70% of the entire federal budget. These are not optional line items. These are structural commitments that exist year after year. On defense alone, America spends approximately $800 billion every year. That is more than the next 10 countries combined. The logic behind this spending is global military dominance, maintaining bases across the world, funding alliances, funding operations. But here is what makes this spending dangerous from an economic standpoint. It does not generate direct economic returns. A road generates commerce. A school generates a skilled workforce. A factory generates production. Military spending of this scale, while serving strategic purposes, does not compound into economic growth the way productive investment does. Add to this an aging population. As more Americans retire, Social Security and Medicare costs increase automatically. The government has no choice but to spend more simply because the population is getting older. And then add COVID, the pandemic relief programs, the stimulus checks, the business support packages. They were necessary at the time, but they added trillions to an already stressed balance sheet. And then add infrastructure programs, add military aid, add foreign assistance. The result is a government that structurally spends far more than it earns every single year. That is the first river. The second river is the tax problem. Revenue is the other side of the equation. And for decades, America has been systematically reducing the taxes it collects, particularly from the wealthiest segment of its population. This traces back to a philosophy introduced in the 1980s called trickle-down economics. The idea was logical on paper. If you reduce taxes on the wealthy and on large corporations, they will invest more, hire more people, pay higher wages, and the prosperity will slowly spread downward through the economy. The wealth would trickle down. The data tells a different story. Over decades of tax cuts, the distribution of benefits has been heavily skewed. The richest 20% of Americans received approximately 65% of all tax cuts, while the bottom 20%, the lowest income group, received roughly 3%. The result, the gap between the richest and the poorest in America has been growing consistently since 1990, measured by something called the Gini coefficient, a standard economic tool for measuring inequality. America's inequality has been on a steady upward trajectory for more than 3 decades. Now, here is where this becomes a debt problem and not just an inequality problem. When governments cut taxes, particularly on the wealthy, revenue falls, but spending does not fall at the same rate. So the gap between what the government earns and what it spends grows wider. And to fill that gap, the government borrows more debt every year. That is the second river. Now, these two rivers, excessive spending and falling revenue, combine to create the third river. And this third river is the one that truly terrifies economists, the interest problem. America now pays approximately $1 trillion every year just in interest on its existing debt. Think about that number carefully. $1 trillion. Not spent on roads, not on hospitals, not on education. Just paying the cost of having borrowed so much in the past. To give you a sense of scale, $1 trillion in interest payments is more than the entire GDP of 174 countries in the world. And this is where the debt spiral becomes truly dangerous. Here's the cycle. The government runs a deficit. To cover the deficit, it issues bonds. Issuing bonds means taking on debt. That debt comes with interest payments. Those interest payments increase total spending. Higher spending widens the deficit further. To cover the wider deficit, the government issues more bonds. More bonds mean more interest. More interest means more spending. And so on. This is not a theory. This has been happening for 20 years, and it is why the debt has gone from manageable levels to $36 trillion today. America's Congress actually put a legal limit on how much debt the government can take on. It is called the debt ceiling. The idea was to create a point at which lawmakers would be forced to have a serious conversation about spending and borrowing. But here is the reality. Since 1960, the United States has raised or suspended its debt ceiling more than 70 times. The ceiling was never really a ceiling. It was always a floor that kept getting lowered. Now, you might ask, if they have raised it 70 times without catastrophe, why is this time different? Why is the IMF raising red flags now? Why did Moody's downgrade America's credit rating? Why are serious economists calling this a potential economic heart attack? The answer lies in a shift that is quietly happening in the global bond market. Every time America needs money, it issues treasury bonds. Countries and institutions around the world buy these bonds because U.S. Treasury bonds have historically been considered the safest investment on earth. If everything else collapsed, U.S. bonds would survive. That was the assumption. But look at what has been happening over the last decade. In 2012, China held $1.3 trillion in U.S. Treasury bonds. Today, that figure has fallen to approximately $759 billion. Japan, once the largest foreign holder of U.S. debt, has also reduced its holdings significantly from $1.84 trillion to around $1.06 trillion. The demand for U.S. bonds is falling at the exact moment that the supply of bonds is increasing. When demand falls and supply rises, prices drop. And when bond prices drop, yields rise. Higher yields mean America has to pay higher interest on new borrowings. Higher interest means the debt becomes more expensive. And more expensive debt means the spiral accelerates. This is the debt trap that economists have been warning about. And then there is a new development that has made this situation even more urgent. The current administration in America passed what has been called the One Big Beautiful Bill. This legislation makes previous tax cuts permanent, increases military spending, and reduces healthcare and welfare budgets. And according to analysis, this bill could add anywhere between $3.3 trillion and $5.2 trillion to America's national debt. For context, $5 trillion is roughly equal to the combined GDP of India and Germany. If this bill plays out as projected, America's annual budget deficit could balloon to nearly $3 trillion per year, and interest payments alone could rise to $1.8 trillion annually. That pushes the debt to GDP ratio even further toward 125 to 129%. So instead of addressing the debt crisis, the policy direction seems to be accelerating it. This is precisely why Moody's downgraded America's credit rating. When a credit rating falls, investors demand higher returns to compensate for the increased risk. Higher returns mean higher interest rates. Higher interest rates mean more expensive debt, and the spiral tightens further. Now, let us address a few misconceptions, because they matter. The first misconception is that America can simply print its way out of this problem. The logic seems simple. America controls the dollar. The dollar is the world's reserve currency, so why not just print more dollars and pay off the debt? The problem is that printing money does not create value. It redistributes it. When you add more currency into a system without adding more goods and services, each unit of currency buys less. That is inflation. And uncontrolled inflation destroys the purchasing power of ordinary citizens far more brutally than it affects the wealthy who hold assets that rise in value with inflation. The second misconception is that national debt works the same as household debt. When a family borrows beyond its means, it faces bankruptcy. But America's debt is more complex. Much of America's debt is owed to itself, to American citizens, pension funds, and domestic institutions. And as long as global confidence in America remains, the system can technically continue. The danger is not immediate bankruptcy. The danger is the slow erosion of that confidence. The third misconception is that this is a partisan political problem. Democrats blame Republican tax cuts. Republicans blame Democratic spending programs. But the data shows that debt has grown under both parties. This is a structural problem, not an ideological one. It is baked into the way the American government is designed to function. Now let us bring this closer to home, because this is not just an American problem. India holds approximately $237 billion in U.S. government bonds as part of its foreign exchange reserves. If the value of those bonds falls, India's ability to defend the rupee weakens, and when the rupee weakens, import costs rise. Oil becomes more expensive, inflation increases, and the ordinary Indian citizen pays the price. India's stock markets are heavily influenced by foreign institutional investors who move billions of dollars in and out of Indian equities. When American markets panic, these investors pull money out of emerging markets like India and move it into safer assets, often, ironically, into U.S. Treasury bonds. Even when U.S. bonds are part of the problem, they remain the perceived safe haven. This happened in 2011. When America's credit rating was downgraded for the first time, foreign investors pulled out of India. The Sensex dropped nearly 10% in a matter of months. The rupee came under pressure. Inflation ticked upward. And today, in 2025, Moody's has issued another downgrade. The setup looks familiar. The rupee-dollar relationship is fragile. India's forex reserves, while substantial, are not immune to a global dollar shock. And if America enters what economists call a debt spiral, the ripple effects will reach every economy, including India's. This is not scaremongering. This is how interconnected the global financial system has become. So what should a financially aware person understand from all of this? First, understand that the American debt problem is not a sudden crisis. It is a slow accumulation of structural decisions made over decades. Tax policy, spending commitments, and interest compounding have all contributed. No single event caused this. Second, understand that the global financial system is built on confidence in the dollar. As long as that confidence holds, the system continues. The real risk is not an immediate collapse. The risk is a gradual loss of confidence, which would make the eventual adjustment far more painful. Third, understand the difference between a government that borrows to invest and a government that borrows to consume. Borrowing to build infrastructure, fund education, or develop technology can generate returns that pay back the debt. Borrowing to pay interest on existing debt or to fund recurring expenses only deepens the problem. Fourth, for anyone watching their own finances, the lesson is clear. The debt trap that America is experiencing at a national level works the same way for individuals and businesses. Spending more than you earn consistently eventually reaches a point where the interest on past borrowing becomes unmanageable. The earlier you recognize this cycle, the easier it is to break. America has the tools to manage this. Quantitative easing, fiscal adjustments, policy reform, but tools only work if they are used wisely and in time. $36 trillion is a number that demands serious answers, not in speeches, in policy. The world is watching, and so should you. And with that, the Black Book closes. Subscribe, and we will open the next page soon.